Welcome back to the deep dive. Today, we're taking a tactical look at a very specific rule-based swing trading strategy.
Hmm.
And our mission here is really clear. We're looking for a shortcut to a structured, high-knowledge return. It's a system that's designed to completely take out the most dangerous part of trading.
Human emotion.
Exactly.
That's right. This strategy, from what our sources say, is really engineered for mechanical execution, for safety. It's all about fixed targets, specific order types, mathematical entry points.
So it's kind of a template.
It is. It's a template for the learner who wants to trade major indices, but, without the crazy risk of individual stocks.
And that safety really starts right there, doesn't it? With
Yeah.
the asset class itself, this whole system is built around exchange-traded funds, ETFs.
Right. Specifically those tracking major indices like the Nifty, Bank Nifty, Sensex. For anyone listening globally, the key context is that these are funds that track the overall market health of a major economy.
And the safety isn't just a side benefit.
Oh no, it's the core engine of the risk management. You see, an individual stock, it can go bankrupt. It can go to zero.
Gone.
Gone. But an index ETF, by its very nature, it can't. It's tied to the entire market, and that diversification is what makes the whole rest of the strategy even possible.
So that structural safety is what allows the strategy to be so disciplined. And the first rule, the most unforgiving one, is all about beating what our source calls greed creep.
Exactly. The number one rule, the most important one, is the fixed profit target. It has to be set at not more than 3%.
Not more than 3.
That's it. This rule is the whole mechanism for defeating your own psychology. You don't get tempted to squeeze out 4 or 5%. You set 3, you take it, and you move on.
It just forces consistency. 3% feels modest, but I guess that's the trade-off. Consistency over speed. So what's the expected time to hit that 3%?
Well, the ideal scenario, at least in the back testing, is hitting that target in about 3 to 10 days. That's the goal.
Okay, that's pretty quick.
It is. But, and the source is very open about this, it doesn't always happen. You have to be ready for, well, for longer waits, sometimes 15, 20, even 30 days.
30 days. I even saw a mention of 40 days in there.
Sometimes even 40 days, yeah, just to capture that 3%.
If you're tying up your capital for 40 days just for a 3% return, you really have to start asking about opportunity cost, don't you?
You do. And that is the central tension of this whole strategy.
Yeah.
I mean, from the strategy's point of view, getting 3% in 30 days is still a good result.
Because the risk of losing your capital is so low.
Precisely. It sacrifices that speed for a mechanical, almost low-stress consistency.
And that commitment to consistency brings us to the entry point, which is also completely mechanical. We're not reading charts here, are we?
No chart patterns, no complex indicators. We're using a single objective number, the VWAP.
The volume-weighted average price.
That's right. The trade entry is based entirely on the previous day's VWAP. You just place your buy order at that specific price point.
So why is VWAP the magic number? Why not say the previous day's closing price?
Because VWAP is a huge indicator for institutional investors. You know, the FIIs, the DIIs.
The big money.
The big money. They often want to get in or out of positions right around the volume-weighted average price. So by setting your entry there, you are essentially aligning your order with the levels where they're comfortable doing business. You're sort of tagging along.
That's smart, but just tagging along isn't enough, right? You need protection from volatility from those morning gaps, and this is where the order types come in.
Yes, exactly. This is critical. To execute this, you have to use a limit order, an LO, and you have to place it as an aftermarket order, an AMO.
So you place it the night before?
Anytime after 3:00 p.m., before 9:00 a.m. the next morning, it just queues your order up and makes sure it's ready to go at the opening bell.
Okay, so why is that limit order so non-negotiable? It sounds like it's designed to use market gaps to your advantage, which can be the riskiest part of trading.
It flips the risk on its head. I mean, its main job is protection, but the huge benefit is what's called price improvement. So let's take the buy side. You want to buy an ETF at 100, which was yesterday's VWAP. You set your limit order to buy at 100.
Okay, what happens if the market gaps up or down?
This is the best part. If the market opens lower, say at 99, your order executes at 99, the better price. You just got a discount.
Nice.
But, and this is the key, if the ETF gaps up to, say, 102, your order does not execute.
So you don't chase the price.
You don't chase it. It's a protection mechanism. You don't emotionally overpay because of a big morning spike.
That's a huge safeguard. So what about on the exit? for that 3% target.
It works the same way, but
Ah.
this is where you can get that massive upside. Let's say you bought at 100 and your 3% target is 103, but the next day the market opens at a 105.
Your order executes at 105.
It executes at 105. You just captured 5% instead of your planned
Sure.
3%. It automatically captures those sudden favorable gaps for you.
It's a purely mechanical way to get the best possible price. Okay, let's get to trade management, because this is where the strategy says something that, for me, is just pure swing trading heresy. What happens if the trade goes against you?
Right.
Does it use a stop loss?
It does not. The strategy explicitly says no stop loss.
Wait, no stop loss.
None.
For a swing trade, that just sounds incredibly dangerous. I mean, why would the source ever recommend abandoning the most basic risk management tool?
And this is where we have to circle all the way back to the beginning, to the asset class,
The ETFs.
the ETFs. The strategy's argument is that since you're trading these big diversified index funds assets that are assumed to never ever go to zero, you can use your capital as the risk management tool. So the solution for a losing trade is simply to
More.
continue averaging out. You just keep buying more until your blended average price can hit that 3% target.
So the commitment is absolute. You're just betting on the long-term upward trend of the market to eventually bail you out, even if it ties up your money for weeks.
That is the core assertion, yes. It requires faith in the market itself. And this was backtested on a few different assets. Nifty Bs, Bank Bs, and also some NASDAQ 100 trackers.
And what did the results look like when things went well? I'm really curious about that price improvement story.
Yeah, that example really shows the power of the limit order. So in one trade on Nifty Bs, the 3% exit target was calculated at, let's say, 192.47.
Okay.
The next morning, the market just gapped open massively higher. It hit 199.8, and because the system used a limit order, the trade executed at that much higher price.
Hold on. So your mechanical system, which is designed to kill greed and just hit 3%, it accidentally delivered, what is it, almost 7%?
It delivered 6.92% profit, nearly double the target.
Wow.
That's the system rewarding you for being disciplined. You're not lucky, you just capture the entirety of what the source called a miracle gap. And overall, the results were pretty strong. They showed about 12% profit, so 4 successful 3% trades in just 1 month.
That shows the discipline can really pay off when you get momentum. But every strategy has a dark side, and we've been hinting at it this whole time.
Absolutely. The primary #1 drawback is that waiting period. The patience you need when a trade goes against you and you're stuck averaging down.
And do we have a specific example of how long that can take?
We do. The source points to one trade that was entered on September 6th,
Okay.
and by October 7th, it still hadn't hit its target.
So over a month, over 30 days of locked capital.
Locked up. You have to be willing to commit your money for 30, maybe even 40 days just to earn that one single 3% gain.
So wrapping this all up, what does this mean for you, the listener? We've just gone through a deeply mechanical strategy. It combines the safety of index funds with these cold, hard entry and exit rules, VWAP, AMO, limit orders to enforce discipline, and, well, sometimes capture some amazing upside.
It's a fascinating study in just substituting rules for emotion. But, and this is the big but, it relies completely on the belief that averaging down in an EPF is always safe. And that means you have to accept the opportunity cost.
Which brings us to the final critical question for you to think about. You've got a system here for earning 3% with what seems like maximum safety, but it comes with this liability of totally unpredictable holding times. So does the benefit of that slightly safer 3% trade outweigh the opportunity cost of having your capital stuck for 20, 30, even 40 days when other faster opportunities might be out there? You now have the knowledge to weigh that risk for yourself.